In this episode, we're talking budget 2018.
Hello, everyone. Today, Canadian budget just recently
Released last week. Third one in this government, yeah.
So wanted to shed some light, especially because we deal with a lot of business owners, shed some light on some of the changes that are coming through the pipe that they need to be aware of and plan for moving forward. Before we go into the information for business owners, let's start with the personal side of things.
Yeah.
What are the changes that we're seeing, and how is this going to be affecting Canadians?
Yeah, this, the primary changes that were announced do relate to business owners, but there were some things that applied to the individual. This budget was really all about equality, creating more equality, and there was lots of that in there. So there's a big push towards the wage gap and leveling the playing field between men and women, and in particular with government employees, that was built into this federal budget. So we're seeing a common trend with this Liberal government. They're pushing towards more equality. They've been making announcements and making programs around that for the last 3 years.
Mm-hmm.
So no surprises there. That's one of the changes that relates to that could relate to you personally. There's some changes related to trusts as well. There's going to be more identification required for beneficiaries, trustees, and settlors.
Mm-hmm.
So if you have a trust, there may be some more reporting requirements needed. Which it'd be too difficult to go through all of that in this video, but there may be some more reporting requirements needed. Tax specialist, if you have a trust, you should talk to your tax specialist about that.
Yeah.
They might have to just do some more filing and reporting. A big one that there was rumors around they were going to change the capital gains inclusion rate. There seems to be like every year there's rumors that the government might change the rate so that we might have to pay more when it comes to capital gains tax. Thankfully, they left that alone. It still remains at 50%, so only half of your capital gain is taxable. So that's kind of a nice thing that again we expect. Well, there was rumors, so it's nice to see that they left that alone
For now.
For now.
Moving on to business owners, lots of anticipated changes that we've been watching, and so have our clients.
Mm-hmm.
Do you want to get into some of these changes that we saw?
Yeah, absolutely. So this was a highly anticipated budget because of the tax changes that were announced last year, with very little details around how those changes were going to be implemented. So good news is we have more clarity on how these things are going to work going forward. To start things off, they have announced that they are dropping the small business rate from 10.5%. It's down to 10% starting this year, 2018, and it's dropping down to 9% in 2019, January 1st. So that's a nice little break. The small business rate is dropping down. Some of the big tax changes that were announced were related to passive income within a corporation.
Yeah,
that's the big one that everybody was really worried about. So we have more details around that today. I think the good news is that people thought it was going to be a lot worse than it ultimately ended up being. So how it's working is every year, essentially, if you have a corporation with passive income being generated, you're allowed up to $50,000 of passive income
within the corporation.
Within the corporation. Above that $50,000, this is where the question marks were. What's going to happen is above the $50,000, for every dollar that's produced above $50,000, $5 is going to be removed from your small business exemption,
which is $500,000.
Which is $500,000. Okay.
So that's where you pay the now 10% dropping down to 9%.
Right. So as that reduces down, and as your income in the business goes above that, whatever that figure ends up being, your tax rate is going to go up, because above that small business rate, that $500,000 to start, it goes up to 27%, right, in Manitoba. So what this basically means is that if your passive income in the corporation goes above $150,000, it will chew right through your small business exemption rate.
So
which you're paying the full rate at that point, the 27%. So that's where this is really important to know what's going on in your corporation, to know how income is being generated, because there's going to be some tax planning needed in your corporation at this point. Just a little bit different than it was before.
Yeah.
On the income sprinkling side, no surprises there. I mean, they announced what they were doing, and there's no changes there. Where where there's going to be some planning required is if you were paying dividends to let's say a spouse who's a shareholder in the corporation before, and that's how you're splitting some income, there's going to be stricter rules around who's allowed to get dividends and who's not, okay? And so you're going to have to be really careful around that and make sure that you're abiding by the rules, otherwise you could get burnt by penalties, etc.
Again, working with your tax professional to make sure you're on side and everything's... dot all your I's, cross all those T's.
Yeah, exactly. So that's not a surprise. They announced that already. That's just gone into effect. So you might have to change the way that you've been taking income out of your corporation, though, and that's where your tax planner is going to get involved. What was a bit of a surprise is there was really no grandfathering included in the budget.
And everyone was talking about the grandfathering. Oh, they're probably going to grandfather. And I think there was even discussion amongst themselves, the government, that there may be some grandfathering. And this was definitely a surprise.
Yeah, it changed the way that we were looking at it, because what the original proposal was on the passive income in the corporation was that any assets that are already in the corporation were going to be grandfathered through. This is where the worry actually was, because there's going to be a compliance nightmare for your accountants. There was going to be so much work probably to be done. So they removed the grandfathering, which, there's people on both sides of this one. I'm just going to tell you what it is. They've removed the grandfathering. I'm not going to give you an opinion on what I think it should have been. So it's removed, it's taken out. So what you're dealing with, again, just on the passive income is up to $50,000 is good. Above $50,000 up to $150,000, it'll start affecting.
Start eating away at that small business deduction.
Exactly.
Well, with all that, Grant, what does this all mean for Canadians and business owners in particular?
Yeah, I think that if you're a business owner with a corporation, or especially if you're an incorporated professional, what this means is that there's some tax planning work to be done. You need to change the way that you were doing it before to the way that's going to work better today based on these new rules. And so if you have questions about that, certainly speaking to a tax professional is a good idea. And certainly chatting with us about it would also be a good idea, and we'd love to chat and hear about your situation and provide you some guidance around it. So feel free to reach out to us, and we'd be happy to discuss your personal situation further.
Well, with that, we're going to close it out. We hope you enjoyed the episode and got some good information out of it. Check out our new website, www.whitehoustonwealth.com. Newly formed team, as we mentioned in the past episode. We've brought on another advisor, and exciting times here at the White Houston Wealth Advisory Group.
So yeah, thanks very much for watching, and ready,
aim,
fire.